I mean, look, the history of Bitcoin is a history of the largest buyer handing off the baton to the next group of capital, right? So before Strategy, it was GBTC who bought a ton of Bitcoin. I think they got up to 600,000 Bitcoin or something absurd like that. Before GBTC, it was US retail investors. Before US retail investors, it was Asian retail investors. Before Asian retail investors, it was cypherpunks. And even if you go back to that beginning, right, people were like, well, who else will buy? Everyone who's a cypherpunk is already in Bitcoin. What is the next marginal buyer? And the answer was there was this series. It was like a Russian doll of marginal buyers. The good thing about the point we're at right now is we know who the next marginal buyer is the end boss of investing. It's institutional capital, which is talking about trillions upon trillions of money, of dollars.
According to Matt Hogan, the market has already moved on, and the next wave of institutional capital could be the catalyst for Bitcoin's next major bull market. Matt Hogan argues that Bitcoin is entering a new chapter as Strategy's dominance over the market steadily fades. For years, the company served as Bitcoin's largest corporate buyer, shaping investor sentiment through its aggressive accumulation strategy. However, Hogan believes that its influence has become increasingly neutral as Bitcoin matures into a broader institutional asset. Recent market behavior supports this view. Even during periods of intense pressure on Strategy's stock and concerns over its capital structure, Bitcoin remained remarkably resilient. More notably, the cryptocurrency rallied after Strategy sold some of its holdings, suggesting investors viewed the company's more disciplined capital management as a positive step that reduced fears of excessive leverage and forced liquidations. Hogan also notes that Strategy's adoption of a new capital framework, which allows Bitcoin sales of up to $1.25 billion for dividends, reserves, and share buybacks, reinforces the idea that the company will no longer be a one-way buyer. Instead, it will operate more like a conventional financial institution, buying and selling Bitcoin based on market conditions. Looking ahead, Hogan believes the baton is passing to institutional investors. Banks, pension funds, sovereign wealth funds, and financial advisors represent trillions of dollars in potential capital, making them the next major driver of Bitcoin demand. With institutional interest continuing to build and market sentiment stabilizing, Hogan believes Bitcoin may be approaching a cyclical bottom, setting the stage for a stronger bull market later this year. Do you think institutional investors will fuel Bitcoin's next major bull market? Share your thoughts in the comments below. And if you found this analysis valuable, don't forget to like, subscribe, and share for more expert Bitcoin and crypto insights.
Point of view was that Strategy has been a dominant factor in Bitcoin for the last handful of years. It was the largest buyer, and I think those days are over. Now I think it's more of a neutral factor. I'd actually point to two things, John, that I saw over the last week or so. First, when we were at peak Strategy stress, when we saw Stretch trade down to $74, $75, when we saw MicroStrategy stock trade actually below its total enterprise MNAV. We were at peak stress. Bitcoin didn't care. Bitcoin didn't move at all. I think at one point, Stretch was down double digits, Strategy was down double digits, and Bitcoin was flat. That told you something, which is that Strategy is no longer in charge. And then indeed, as you point out, when they actually sold Bitcoin, Bitcoin actually rallied on that news. I think the reason it rallied is people were worried that Strategy would sort of stick its head in the sand and continue down a pathway of issuing Stretch and building up risk in that ecosystem. And it turned out that they're actually what we all knew all along, which is a rational actor in this space that realized it needed to raise capital. People downrated the probability that they'll be forced into some stressed liquidation event. And so Bitcoin rallied a little bit on the news. Look, I think I'll go back to what I said in my memo and at the start of this commentary. I think Strategy was the largest actor in Bitcoin for the last few years. It will still be important, but it's no longer the primary source of marginal capital. I think that's shifting to institutional investors. And I think that's what we're seeing in the market today.
Beautiful Pacific Northwest with our distribution team meeting with clients all around the region. And what's interesting is that I've had several conversations and questions about Strategy. Those questions have ranged from, is strategy, do they represent a concentration risk for Bitcoin? They've asked, is strategy going to blow up? Is it a problem that Saylor sold his Bitcoin? Each time I articulated essentially what Matt just said. Look, this isn't a major long-term concern for Bitcoin. I think it's actually good that the market is digesting the fact that strategy is not going to be buying a million Bitcoin every 5 years into the future, and that they will be sellers and buyers of Bitcoin depending on the environment. And what I found interesting was every time we had those conversations, the response from the client after they asked the question I answered, their response was, yeah, I agree. I don't think it's a big deal. And that to me was really, really interesting, because I think that signals exactly what we're talking about. There was a big concern about this a while ago. Today, it's no longer a concern. Actually, the marginal buyer are the institutional investors that we are meeting with every single day.
But the history of Bitcoin is a history of the largest buyer handing off the baton to the next group of cap, right? So before strategy, it was GBTC, who bought a ton of Bitcoin. I think they got up to 600,000 Bitcoin or something absurd like that. Before GBTC, it was US retail investors. Before US retail investors, it was Asian retail investors. Before Asian retail investors, it was cypherpunks. And even if you go back to that beginning, right, people were like, well, who else will buy? Everyone who's a cypherpunk is already in Bitcoin. What is the next marginal buyer? And the answer was, there was this series. It was like a Russian doll of marginal buyers. The good thing about the point we're at right now is we know who the next marginal buyer is the end boss of investing. It's institutional capital, which is talking about trillions upon trillions of money, of dollars. And we feel very confident that it's going to come into the market. In fact, we're meeting every day with financial advisors, with clients, with sovereign wealth funds, and they are all still interested in this space. So almost unlike all those previous examples where there was really this question of who would be next, right? We weren't talking about digital asset treasuries being the driver of Bitcoin during the peak GBTC days. We were like, I wonder what's next. The answer now is clear, which is institutional capital. I think they're going to take the baton and run with it starting at the end of this year and accelerating for a number of years after that. And I think it's going to be a great bull market for Bitcoin.
As Wall Street embraces tokenization and decentralized markets, DeFi could be entering its biggest growth cycle yet. Decentralized finance is rapidly emerging as one of the most transformative themes in digital assets, with industry leaders arguing that blockchain technology is expanding far beyond cryptocurrency trading. Ryan Rasmussen believes recent developments, including Robinhood's launch of a Layer 2 blockchain for tokenized stocks and Hyperliquid's growing challenge to traditional futures exchanges, demonstrate that DeFi is evolving into infrastructure for global financial markets. This shift is already influencing investor sentiment, as Bitwise DeFi Index has gained more than 50% over the past 3 months despite weakness across much of the crypto market. Rasmussen argues that protocols such as Uniswap are no longer competing solely for crypto trading volume, but are targeting the vastly larger markets for stocks, commodities, bonds, and derivatives. He also expects the rapid expansion of stablecoins to drive growth across Layer 1 blockchains like Ethereum, Solana, and Hyperliquid, while benefiting infrastructure providers such as Chainlink and companies including Coinbase and Circle. Supporting this outlook, Pantera Capital says Hyperliquid highlights how on-chain perpetual futures are becoming credible alternatives to traditional exchanges, with decentralized perpetual trading already reaching 14% of centralized exchange volume. Matt Hogan adds that improving regulations and stronger collaboration between traditional finance and DeFi will allow decentralized applications to capture more value, making the sector one of crypto's most compelling long-term investment opportunities. Let's get back to the interview.
I mean, think about what the biggest news in finance is this month. It's probably Robinhood launching its own Layer 2 and people accessing tokenized stocks and, getting prepared to borrow and lend them on platforms like Morpho. Think about the largest story in finance last month. It was Hyperliquid challenging CME and ICE and other futures markets on perpetual futures and how finance will work in the future. Not about trading Bitcoin perps, about trading oil perps. And one thing we've been talking a lot about internally at Bitwise is that DeFi assets have been performing exceptionally well. We have a DeFi index of 10 of the largest assets. It's up 51% over the last 3 months, which has been a terrible period for most of crypto. Usually in the deepest, darkest bear markets, you don't have small cap assets rallying. Why are these assets rallying? They're because of what I wrote. People are re-rating this market upward 200x, right? It's tackling a much bigger market. Uniswap is not about trading ETH versus Solana. It's about trading stocks versus commodities versus crypto versus bonds. That's a 200x bigger market. And I think people are going to continue to re-rate these assets upward. The total market cap of the DeFi space is way too small for the market it's going after. Once you get beyond Hyperliquid, the next largest DeFi assets are like $2 billion protocols. I think that could look just absurd in a year or so if it continues on the progression that it's been on.
Ryan, I want to ask you a question that has come up over.
Yeah, I mean, it's a really good question. It's one that we get all the time is, look, if stablecoins are going to grow 10x over the next 3 years, how do I get exposure to that as an investor? And I think the answer is that it's several different areas of the technology stack or the stablecoin stack where investors want to have exposure to capture, some relative portion of that growth. And so I think the layer one blockchains are inevitably going to benefit from this. All of that activity that happens with stablecoins settles on top of blockchains like Solana or Ethereum or Hyperliquid. So I think that's one way to gain exposure and to express your view as an investor that stablecoins are going to generate a lot of value. Another area is the level up in the infrastructure, like Chainlink, for instance, or oracles that are necessary for all these applications to speak to each other and blockchains to speak to each other and DeFi apps to work in the way that they do, or prediction markets to work in the way that they do as stablecoins grow as they're in their usage in prediction markets. So I think those will also be areas to capture value. And then, of course, stablecoin issuers, I think, will be large, beneficiaries from the growth of stablecoins. And that, is relatively clear. But think about the size of these markets. U.S. stablecoin issuers are the 15th largest holder of U.S. treasuries, right? That's like an insane number. It's more than Germany and Norway and UAE. And that means that they control an incredible amount of capital that's only going to grow. And they're earning a large margin today on the interest those reserves generate. Now, maybe it'll shrink over time, but I believe that the assets they manage or the reserves they manage backing the stablecoins will grow at a much faster pace over the long term. And so I think it's stablecoin issuers and infrastructure companies like Coinbase and Circle. I think it's the middleware companies like Chainlink and other oracles and the layer one blockchains like Ethereum, Solana, Hyperliquid, and others.
Matt, anything to add on that? Is that kind of how you view this as well?
Well, I think that's a big piece of it. I also think just the direct apps are going to be an incredible, Robinhood launched a chain and Uniswap is integrated on it. I'm not sure that that's something that people expected, right? It almost doesn't make sense. Robinhood is a brokerage, Uniswap is a disruptor of brokerage services, and yet it's one of the beneficiaries of that. I think people need to reconsider these applications specifically. I also think, historically under the previous regulatory guidance, applications couldn't accrue value to their tokens. I think that has been suspended, and they're increasingly capturing value. Probably today is the worst they'll ever be in the future. I think they're going to continue to capture more and more value. So the only thing I would add on to what Ryan said is I think people have underestimated the app space in a couple of different ways. One, the size of it, not 2 trillion, 400 trillion. And second, the value capture, not zero, definitely more than zero. And I think when you combine those two, it looks pretty attractive.
The digital asset market appears to be entering a new phase where long-term growth is increasingly driven by institutional participation and real-world financial applications rather than speculative enthusiasm alone. As corporate accumulation becomes less dominant, the expansion of banks, pension funds, asset managers, and sovereign wealth funds into Bitcoin could provide a broader and more sustainable source of capital. At the same time, Decentralized finance is extending beyond crypto-native use cases into tokenized stocks, stablecoins, derivatives, and on-chain financial infrastructure, bringing blockchain technology closer to mainstream adoption. This convergence between traditional finance and decentralized networks is creating new opportunities across Layer 1 blockchains, infrastructure providers, decentralized applications, and digital asset exchanges. As regulations continue to evolve and institutional confidence strengthens, the industry is shifting toward a more mature financial ecosystem where value is created through utility, adoption, and capital efficiency. If these trends continue, the coming years could mark one of the most significant periods of expansion for Bitcoin, DeFi, and the broader digital asset economy. Do you think institutional investors and the rise of DeFi will drive Bitcoin to new all-time highs? Share your prediction in the comments below. Thanks for watching.